welcome to module on the term structure of interest rate part 1. Whenever we discuss about the nominal interest rate or the real interest rate, we basically mean by the cost of borrowing. So by nominal interest rate we mean the interest rates that are observed in the financial markets or the interest rate that is being obtained by depositing an account in any kind of financial institution. So nominal interest rates are basically not adjusted with the level of inflation, and they are affecting the value of most of the securities traded in the money and capital markets. This interest rate can be observed at home, that means in the domestic country, or in the foreign country where we have the international interest rate prevailing. So interest rates play a very important role in the determination of the value of the stock in any financial institution, or it is basically the rate of return that is being obtained. So moreover, in the discussion of the interest rate, we want to find out what kind of market framework the interest rates play or they function. And this market framework is none other than the loanable fund market. So the loanable fund theory of interest rate determination says that in any sort of financial markets, the term structure of interest rate, it is determined by the presence of the loanable funds, where just like any market, here also we have the forces of demand and supply. So we mean that the fund is basically treated as a product which has a demand and the supply, and the price of the product is determined as the interest rate that comes in action. This basically gets into the supply of the loanable funds. So first of all, we discuss on the supply of the loanable funds regarding how this supply is being generated. This is being generated by the savings. Because in any nation, the total amount of savings is sum total of household savings and public savings. So by household savings, we mean some of the governments or the municipalities which are basically concerned about the household savings, and by the public savings we mean basically the government sector which comes out of it. So when we say the loanable funds are supplied by some of the governments, we mean some governments, for example, generate more cash inflows through local taxes like the municipalities or the corporations, and which they want to spend it off. So basically in the supply of the loanable funds, we measure the rate of return that is determined on the funds. So when the interest rates are higher on financial securities than their comparable securities at the home countries, foreigners investors increase the supply of funds to the market. This means that internationally if the rate of return is less and domestically the rate of return is more, then definitely the foreign investors will invest more in the domestic markets, and thereby the supply of funds will be on the rise. This boils down to the equilibrating interest rates that come in action. And that is how the supply of loanable funds play an important role. In this particular context, we mean to say that the foreigners access not only the interest rate but also on the total wealth. So in the domain of interest rate structure discussion, it's very important to identify the risk that is associated with the foreigners, because they do not motivate or they do not actually go for more and more investment on the financial securities, but also they have an access over the total wealth, the security risk, and also any sort of future expenditures. So foreign investors alter the investment decisions in the home country, the exchange rate, and that is how the rupee changes in exchange of the US dollars. So these fluctuations in the exchange rate are also being captured by the foreign investors, and that is how the home countries actually behave. Basically, the level of savings is generating the supply of the loanable funds, which is motivated from the lenders, and as a result we can say higher the rate of return, more will be the lenders and more will be the supply available. So that is how the supply of loanable funds comes out to be upward rising, and which will be affecting the loanable fund market. Moreover, on the other hand, in any market framework, we also have the apparatus of demand, because these two forces act together. So thereby we invite demand for loanable funds. So by demand for loanable funds, we look at the investor's perspective. That means the borrowing or the cost of borrowing, which will be captured by the interest rate. So here we say in general that quantity of the loanable funds demanded is higher as the interest rate fall. So whenever the interest rate fall, the cost of borrowing is on the fall, then the demand for loanable fund rises. So other factors remaining constant, more funds will be demanded if the interest rate is on the fall, and that is how the demand will be motivated. Households, who are the net suppliers of the funds, also borrow funds in the financial markets. So thereby the households also act as a borrower, and they basically borrow funds in order to find out any kind of estimate or any kind of investment projections in the future years. So demand for the loanable funds can be done by the household sector, because households also go for financing on the purchase of homes, that is the mortgage loans they take, or in case of purchase of any item like car, appliances, then also we go for the durable loans, or for non-durable goods like education loan, medical loans and all these sorts. So here we observe that the loan is basically taking up from all different kind of activities, either in case of the mortgage loan, or in case of the durable goods, or in case of the non-durable goods. Everywhere we find out that the loan comes up and the demand for loanable funds takes a peculiar shape. So moreover, we say that the business demand funds to finance investments in long-term assets. So whenever we come with the businessmen and we want to finance the investment, then we go by the long-term asset like plant and equipment. Short-term capital needs are also being done, like the inventory accumulation or by the accounts which are receivable, or any other debt or financial instruments. So in all these cases, we observe where the demand for loanable funds originate. They originate from the borrower's perspective, where thereby they want to stand up a machinery or to set up any kind of working capital or a factory or any kind of issuing debts. That is actually the origin how the demand for loanable funds come up. So basically we have a number of portfolio projects available to businesses. So better to overall economic conditions, greater will be the demand for loanable funds, because we find out that more and more investment decisions will come up if the investment climate is conducive. So in this regard, governments or households can heavily depend on the market for loanable funds, because they issue bonds as well as they raise money in the public, and whereby the demand or the investor's perspective is taken into account. So thereby we invite a question on what is meant by the demand for loanable funds, which originates from the borrower's perspective or the investor's perspective. So whenever we proceed further to explain the term structure of interest rate, then given the loanable fund framework, it is very much necessary to relate rate of interest with inflation, because this rate of interest acts as a rate of return on the supply of loanable funds and the cost of borrowing from the investor's point of view. So thereby the most important element is how the interest rate will be affecting the inflation. So it is said that higher the level of expected inflation, higher will be the level of interest rate. This is very important because inflation and interest rate having one-to-one correspondence. So the intuition behind the positive relationship is this, that inflation makes the investors who buys a financial asset must earn a higher interest rate where inflation increases. Because in order to compensate the foregoing consumption today and buying these highly priced goods and services in the future, the nominal interest rate is kept higher in accordance with the expected future inflation rate. Because whenever a borrower or a lender enters into a loan agreement, then the interest rate is decided on the future perspective. Keeping in mind the expected level of inflation, the nominal interest rate is set. So that will be better off from a borrower's perspective is the rate of interest rate is on the rise, on the sense that it will get a good return on its investment. On the other hand, we say that the first and the most important element in this case is the expected inflation also. This boils down to the issue of the relationship between the interest rate and the inflation. So we see that higher the level of actual or expected inflation, higher will be the level of interest rate, and they are having a one-to-one correspondence, which can be basically determined by the Fisher effect and which explains the theoretical foundation between the two. So this boils down to the discussion on the Fisher effect. So what is Fisher effect? The relationship among the real interest rate, which means adjusted with the level of inflation, that is the current inflation, expected rate of inflation, which is considered as the future inflation when the loan will be repaid, and the nominal interest rate, which happens to be the cost of borrowing. So these three factors are considered together. Firstly, the real interest rate, secondly, the expected interest rate, and thirdly, the nominal interest rate. These are going together, and this is referred as the Fisher effect, which is named after the economist Fisher, who identified the relationship. So Fisher effect also explains how the nominal interest rate are observed in the financial markets. Like when an investor purchases a security that pays interest. So security in the sense any kind of bond, any kind of financial instrument, any kind of debenture, where the nominal interest rate exceeds the real interest rate because of inflation. Because the nominal interest rate is set today, depending upon the current inflation, but it is adjusted with the future inflation. So if the nominal interest rate is falling short of the real interest rate, then definitely investors will purchase a security with expecting more returns in the future. So Fisher effect incorporates inflation. It replaces the current inflation by the expected inflation in this case. So we have seen that in any kind of loan agreement, the Fisher effect plays an important role. Moreover, we have another important concern, which is of the default or the credit risk. So by default or the credit risk comes in because the investor in case of the foreign exchange market has a total access over the wealth or the financial wealth. So when we go for a default risk, which means a security issuer will default on making its promised interest and principal payments to the buyer of the security. That means the security who is a buyer will be paying the loss, and thereby it is an issue of defaulter if such kind happens. So higher the default risk, which is very much there in any kind of international transaction or any kind of international bond purchase, higher the interest rate that will be demanded by the buyer, and that will compensate him or her for this default risk. So we observe that the default risk will be higher if the interest rate happens to be higher, and that is how one of the most important factors in the context of interest rate structure. Now we go by the internal factors affecting the interest rate. So by internal factors we mean that how can we take care of the default risk, which can be taken care of one of the most important factor affecting it. So that is being divided into two types of risk as it appears: business risk and financial risk. So by business risk it refers to the variability of operating incomes or earnings before interest and tax. It is influenced by demand variability, price variability, and operating leverage. So when we discuss about the business risk, it actually takes care of the operating incomes or the earnings which are fluctuating before any imposition of tax or before any interest rate comes up. So this operating income or earnings are basically affecting the level of the loanable fund market, It's also affecting the response of the demand and the supply of the investors. It also takes care of any kind of demand factors. So by demand factors we mean the demand that is arising from the fund or the demand that is arising from the borrower's perspective. By price variability we mean any kind of factor which shoots up because of inflation or because of any kind of price inducing factors. That is what the variation in the prices comes up. So demand and prices are considered to be inherent from the household or from the borrower's perspective, and thereby the variability is being done. This also takes care of some kind of income or earnings that are taken with the help of interest rate and taxes. This interest rate takes care of inflation, and taxes are basically the compulsory payments which are being done. Here is a concept of operating leverage which says that how the business risk is associated with that in case of mortgage or in case of any kind of defaulters. Now we focus on the second type of risk, which is also an internal factor affecting the interest rate, that is the financial risk. Because if the level of all these risks are higher, then the interest rate also will be higher. By financial risk we mean it is the risk arising from the use of debt capital. So when we talk about the debt capital, we mean that the debts which are floated in the international market, and a firm can depend highly on the debt capital, and then the financial risk exposure also will be high. So whenever we talk about any kind of financial risk exposure, then we can see how the heavy dependence comes in. So financial risk is basically the risk arising out of the debts. It also the risk which is dated on the capital, and some financial risk exposure also comes up there. So these two risks are measuring the level of the risk in a broader degree, and that is by the interest rate also will happen to be on the rise. And thereby in any kind of transaction, whether it is being done by the international market or by the domestic counterpart, these two levels of risk must be well established, and they must have a proper forum where the mitigation of the risk can be done. So now we move on to any kind of external factors which can affect the interest rate. For example, when we discuss about the amount of currency in circulation, sometimes it happens that whenever the amount of new currency comes up or any new denomination comes up in the market, then the market value of the old currency falls. That is, erosion takes place in the purchasing power of the currency. So this purchasing power risk is also one of the risks which can affect the interest rate. That means investors' money may lose its purchasing power because of inflation. Because inflation can be one of the eroding factors where the investors' money in the sense in terms of the purchasing power of the old money as more new money enters into the system. So this type of variability is often explained by the index number, which is considered to be the price index. Price index means the price of the current year relative to that of the base year, that is Pn by P0, and that also measures the rate of inflation and the rate of purchasing power. Price index also includes a good basket of consumer goods, like it includes food, clothing, housing, health. All these consumer goods are taken up within this basket, and thereby the price index can be computed. If it is only considered of the consumer goods, then we say consumer price index, which has a tendency of overstating inflation. So by overstating inflation, we mean that suppose we give an example of agricultural crop which gets destroyed in a particular year due to natural calamity. So that is no longer visible in the consumption basket. So that means whenever we are calculating consumer price index, we are making the consumption basket of the old year or of the base year to be constant, as if people are purchasing the high price goods even if they are available at higher prices. But whenever we consider a price relative or a price index, we compare the current price with referring to the base price. So in the new year, that particular item or commodity, a household product, is no longer available. But it is assuming, CPI or Consumer Price Index is assuming that the old basket comprises of this item and thereby the high price is carry forwarded, and as a result of that, it will be reflected in the price index. This is basically very much making the inflation to be overstated or overestimated, because in Consumer Price Index, it ignores that the consumer has the provision to substitute the expensive commodity by the cheaper commodity. But that has been ignored by the price index, and so it makes a very good saying that whenever this is ignored, it means that Consumer Price Index is basically overstating the level of inflation, and that is being done. So whenever we refer to any kind of external factors affecting the interest rate, which is considered to be as money in circulation, which means new money enters the system, the purchasing power of the old money is on the fall, or any sort of price index, where we mean the price relative, or how with the help of the price index inflation can be overstated, we can explain these are the factors affecting the interest rate. Apart from that, also we can see that interest rate also takes care of investors' money. So that is, investors' money may lose its purchasing power because of the inflation, and thereby the price index comes up where the housing, healthcare, food, all these are taken into consideration. So all these items have a certain weighted average on the basis of which this price index takes place. So in this particular module, we basically concentrate on the term structure of interest rate, where we actually introduce by the type of the interest rate or the concept. Then we develop on the interest rate determination. We go by the loanable fund market theory, where the determination takes place. And for the determinants, we also take care of the risk, which can be default risk, which can be financial risk, or which can also be purchasing power risk, and that is how all the risks are associated with this kind of international transactions. Moreover, it is stated that any kind of indexation, if it is done, which can control the rate of change in the price, that can also be effective in maintaining a proper consumption basket. So in this particular regard, all these items are considered within the interest rate framework, and thereby we can explain that the market interest rate is duly determined.